If you think that managing money is just about numbers on a screen, I think you're missing the bigger story.
And today, Phil Blancato is not only going to share his market outlook, but also the life lessons that he's learned over the years that's shaped his philosophy on wealth and success. Hey, Phil. Welcome to Texas.
Thank you. It's funny. Texas is an interesting place for me. I have a number of very good friends, you being one of them, who I've gotten to know over the years. But it is different here. You know, I just enjoy. I live in New Jersey, right? So driving down the roads that are so
All the way
and
down from New
fast and
Jersey.
easy to get around, it's a little different at home. So I'm happy to be here. Very excited.
You do like visiting Texas, though?
I do like it a lot. I'm lucky to get to see a lot of the state, from Austin to San Antonio to Dallas, Fort Worth, and even down here to Houston. What I find is the people are fantastic, but there's a lot of pieces that make it different. You know, think of Houston, commodities and oil, Austin, forward thinking and tech, and Dallas, Fort Worth as the ag, and suddenly all part of a big place, but all interworking together, which makes it the 5th biggest economy in the world. So I think that's pretty cool.
Your family's from Italy.
Yeah.
That's kind of shaped like a boot, so that fits.
For sure.
Yeah.
Not really a cowboy boot, but yeah, shaped a bit like a boot.
Yeah, we'll give it to you.
I was lucky that, for example, I was a solid C student in high school. I had no desire to be in financial services. And why I tell you the story, my mom came when she was 14, my dad when he was 17. My father's father had passed. My mom was with her parents. And what the United States represented for them was this amazing opportunity to grow and be successful and create your own life. And the lessons that my mom and dad taught myself, my brother, my sister, my kids are invaluable. I'm a very pro-immigrant person. It's amazing how you can tie immigration to success in the United States, but more importantly, demographics. When you have a growing population, you have a successful country. When you have a shrinking population, you don't have a successful.
And we want to talk about that later, too.
Yeah,
so that's why
we should have some fun with that.
Yeah.
So luckily for me, the reason why I'm in this business is my dad left school in the 6th grade. He was a laborer in the United States. As a kid, I could put a new water line in a house. I can help you do a great garden. I can do cement work for you and all kinds of things. But my dad in high school said that when I was graduating, I wanted to build houses. I never had a chance to go to college. I never had a chance to educate myself. Just go. And so my father's influence was to say, try to continue to always better yourself. And sure enough, my own personal story, I was an average baseball player. I played baseball at a very small.
Whoa, Jordan played ball.
Yeah.
I was D3 and relief pitcher in left field and first base.
Yeah.
So I ended up going to a commuter college back and forth. And you're going to laugh at this story, Eddie. I bet I've never told you this. I was not too excited about going to college, but I'm in my freshman year. I have to drive. I'm working 3 jobs because mom and dad didn't have enough to pay for everything. So I'm bartending. I'm a busboy. I'm even, long story, playing in the music industry, DJing. And 1985, my freshman year of college, I have a macroeconomics class. Well, oddly enough, I ended up falling in love with macroeconomics because of supply and demand. The idea of supply and demand got me super excited. And at the same time, you're going to laugh at this. How many remember the movie Trading Places?
Oh, I love it.
So I watched Trading Places, and remember that movie was all about supply and demand. So the movie and my class in economics, macroeconomics, connected me, and here I am 35 years later after graduating college in 1989, and I have never worked a day in my life. Kind of, I add to my story, I went to a very small, no-name college, and when I first got my first job in 1990, where there was no computers, no laptops, no cell phone, no internet, no email, it was all handwritten. I had success because I started calculating performance by hand, you know, how people calculate their monthly returns. One of the portfolio managers took a liking to me, and I was going up against kids from Ohio State and Cornell and Columbia and NYU Institute of Finance and so on. All those kids, they had this real incredible backgrounds, but I had something they didn't have. I had a chip on my shoulder as an immigrant son that was willing to work 80 hours when they worked 40. And I love what I was doing.
I tell my daughter that all the time. She played softball.
Okay.
You could tell there were some kids that have been doing it longer, well more versed in the game. But I said, baby, you know what? The thing is, talent's one thing, but work ethic's another. I said, you can outwork anybody.
That's exactly right. I agree. 100%. It's worked for me. And especially if you love it. She probably loves softball and willing to commit to it. for me, this became my life's passion to make 1 and 1 equal 3. Oh my gosh. Why they pay me for this, I don't know.
Yeah.
And now it's become a life's passion to help people who don't really understand finance. That's why I'm so excited to be here today for the people that we reach. But the idea of helping people realize the power of investing, the eighth wonder of the world, arguably, by Albert Einstein. If we can help the average person have a better life because they don't just get taken advantage of by banks or credit card companies or whatever, then we've had real success.
That's right.
That's part of the reason why I love being.
And that's really what this podcast, Jordan and I wanted to start it for, was because not everyone has the wealth to just hire a financial advisor. But the best time to start investing and growing your wealth was yesterday. The second best time's today. And so by educating people, especially younger folks, just get started.
I think some people saw what 2008 did to family finances and houses, what 2020 did to family finances and houses. And not realizing if folks just did basic little things, put some money in your 401k, minimize your monthly credit card debt. I understand if you can't, you can't. Buy a used car rather than a new car to start. Little things that would get you to where your cash flow is positive and not negative, and boom, you're on your way to success just with something simple like that.
So you shared a little bit about your family backgrounds. What do you think is the most impactful thing people can learn from your family story?
Well, it's a very complicated question because I'll give you a short answer, but maybe it gets you to the right place. We still plant 112 tomato plants every single year. We still make our own homemade sauce. And at the end of the day, I think there's something very valuable of being very prudent about the money that you have. My father invested in me, but he never forgot that it's okay to still grow your own vegetables and be smart about your pennies, save them when you can, but make smart investments. In my dad's case, he invested in real estate and in his children, and it paid huge dividends. For the folks who are watching today, I think it really comes down to if you're willing to sacrifice today, you'll have tremendous rewards tomorrow. And I think that's the lesson that I took away from my mom and dad, that whether you're making your own made sauce, you don't have to go buy it at the store, or you're just being smart that you don't overspend. My dad was incredibly frugal. And I don't mind telling you, my father died with 3 two-family homes, all paid. I live in New Jersey, Westfield, New Jersey. Each home was worth around $1 million. He had about $900,000 in total savings. So his total net worth was around $4 million. This is a man with no education and simply worked hard, saved his money, and invested smartly. If you can do those 3 things, you will be a success.
It's all about good decisions.
We've talked a lot about behavioral finance and disciplines. And one of the truths that I've grown up learning is this, that money makes you more of who you already are. It gives you power to be who you are. So if you're faithful with a little, you're going to be faithful with a lot. And if you're unfaithful with a little, you're going to be unfaithful with a lot, and you're going to end up running out of a lot soon. And so I think that speaks to the way that your father managed not only his own finances, but the way he invested in you. And now that you have more opportunity, what do? Well, you're investing in other people.
I don't know why I've been given so much success by God and how I got here, but to have impact on people, that whenever I'm giving a presentation about economics and folks can walk away and maybe have learned something or help them make a little bit more money or take some of my own personal savings and invest it now in other people, I don't know if there's a greater joy for me. In fact, I'll be honest with you, I don't share this a lot. At 58 years old, I'm trying to understand that if life breaks down into 4 quarters, first quarter, someone's taking care of me. Second quarter, I'm taking care of someone else. Third quarter, I'm taking care of myself to a degree. And now that I get close to that 4th quarter, how do I help the world? How do I leave behind a legacy of impact? And it's powerful because my mom and dad gave me this opportunity. They had impact on me. Now I've had 2 children who I think I've had impact on, but we're lucky enough to be in a place where your podcast may help some people live a better life. That's real impact. So that's exciting to me.
That's the lesson Ebenezer Scrooge learned a little bit too late.
Sure.
Know, it's about the impact that you make in the life of somebody like Tiny Tim.
That's a great point. I love that.
Volatile markets, ongoing client expectations, things of this nature. How do you personally stay grounded in uncertain markets?
I'm going to give you a couple rules to live by. First, I came up with this one, I think, or I stole it. Risk plus time equals reward. Really simple. And risk basically means if you watch your account go down by 5 or 10%, but you panic. So what number gets you really nervous? That's risk. Time, what's it for? Retirement, buying a house, education, or just grow. And then reward would be the combination of those two. The more risk you're willing to assume, the more stocks you're going to own. The more time you have, the more long-term growth you get, the more reward you get.
Mm-hmm.
So I think for the folks who are listening, if you understand that basic concept that you want to bucket your money out, some's going to have long-term, and you can get real risky. Some are short-term. Maybe it's just helping you live every day. Those are different scenarios, and I think you guys are pros at that, so you can help them with that. So that's probably the first lesson. The second one, please hear me out. The most important thing you can take away from this conversation today is never, ever panic.
Mm.
Folks have lost their livelihood by panicking. And why you panic is because some headline, who attacks who, or what war just began, or
So funny you mentioned that, because just today we're on a client call on Zoom. Originally, when he retired, he's got half his money with us, and then he's got the other half in his Fidelity account. And it's just because he has this control bias. This is not a new thing. People like to have their hands on the reins. But we were just sitting there talking to him and going through his rate of return. You guys are managing money, done a fantastic job this year, and I was reporting back. And so he starts talking about his other account with the other firm. And he said that during the Liberation Day fallout, he decided he was going to jump out because he just knew he was going to have time to get back in. Well, you saw how quick that turned out.
Yeah.
So to your point, he's up something like in his moderate portfolio, 8.5% net of fees. And in his other account, he's up 2%.
Oh, gosh, that's terrible. That's a great example. You're right. Because panic makes you make profound mistakes. The market doesn't love you. Don't love it. As long as you're non-emotional about your investments, you're willing to give it time, and please avoid the headlines. The headlines are designed to scare you. If you get scared, you make mistakes. When you think about why does Google make money? Because when you go to Google and you Google a news story, what happens all around the frame of your internet browser? Advertisement. Mm-hmm. When you go onto your phone, advertisement. You watch whatever channel you like, whatever media outlet. What do you get in between every major headline? A commercial.
And who's making money on that?
Very simple. The broadcaster makes money on the advertisement. Why? The more people that watch, the more they get. Why does the Super Bowl cost $30 million a second or whatever the crazy number is?
Mm-hmm.
Because there's millions of people watching. It's valuable. So my point is, if you're just willing to accept risk plus time equals reward, you don't panic on your investing, and you simply have a plan, you will have great success.
So would you agree that the greatest financial mistake that most people make is panic?
Without a doubt. And it's worse than timing the market, because timing the market is a byproduct of panic. But I think people almost take it more so here because it's their nest egg. I'm going to hide a can under my mattress or whatever. Yet
why do you think that is?
Because they don't know the facts. And you know whose fault that is? Our education system and us as an industry. We have not done a good job of helping you all realize that the stock market's average rate of return over the last 100 years is over 8%. The bond market, over 5%. By the way, the stock market and bond market are emblematic of American capitalism. If you think American capitalism makes sense, and you watch the United States grow every single year to be the biggest country in the world, wouldn't you want to invest in that? So the real short answer is it's panic that makes people make mistakes.
How remarkable of an answer is that?
Yeah.
That the single biggest financial mistake people make doesn't have to do with numbers. It actually has to do with an emotion. I've told my kids for a long time, panic is its own problem.
Mm-hmm.
We panic as a response to a problem. So what do we have? Now we have 2 problems. And the emotion of panic actually clouds the mind, where we cannot make rational decisions.
For sure. There are so many examples of this. If you look at the average return for the average investor going back 50 years, there's so much data that suggests they invest at the highest of highs and they sell at the lowest of lows. You want to do the opposite. You want to buy when people are fearful, and you want to sell when they are greedy. If you can just have that philosophy, and you know how to fix that? Put a little bit of money in the market every single month. Easy. We call that dollar cost averaging.
Mm-hmm.
You're probably doing it if you have a 401k. You don't think about it because it's automatic. It goes right out of your account. If you're lucky to be able to make personal investments, obviously with these 2 gentlemen or whoever, you want a little bit each month. Well, then you're averaging out the highs and lows. You're on a path to real long-term success. But if you just think of the math behind it and use history as your guide, the facts, you won't get emotional.
Yep.
By the way, what does panic do? It creates stress,
Yep.
creates anxiety, and it creates bad
And
decisions.
when do you make mistakes?
When you're panicked.
Go back to the baseball. What happens in a baseball game when the team that's on offense starts to foul pitches off, starts to make him throw a lot of pitches, get a runner on base because they force a walk? What ends up happening? The pitcher ends up making more mistakes because he's got more stress on him, leaves a ball over the middle of the plate. Now he
Boom.
gives up the home run. You take that same scenario and you put it on the man who's trying to manage his money. You start behaving irrationally. You can't think straightly. You can't do math.
Hard to watch the movie when you're in it.
That's exactly right.
Yeah. Hey, you're right. That's a great point. I like that a lot.
Doesn't
You're
that
right.
speak to the need, though,
Yeah.
for financial advising?
Yeah.
Because you have someone who is emotionally divested.
Right. Well, that's what I say. It's about that consistency. It's about working the plan, sticking to it. Money management's important, and a lot of people don't want to do that when they want to enjoy their retirement. They want to do those kind of things, but not having a plan, way more impactful, in my opinion.
It's a plan to fail.
Yeah.
And you know what's funny? I think sometimes we all take for granted that folks need an expert in a lot of areas,
Mhm,
a doctor,
right.
a lawyer. But you need an expert in finance. And if you want to do some on your own, I applaud that. I love that millions of people are now in Robinhood trading a little bit of money. That's great because you're investing in companies you know, and you're doing it because there's some idea that you really like. That's outside of your core investment. Your core investment should have discipline, a plan, a structure. Over a period of years, you'll get to great success that you never could have achieved.
Let's talk about what you really do best. So money management.
Thank you.
What do you think has been the biggest challenge post-pandemic to navigating markets?
There's a few things that have happened that have never happened before.
Mhm.
I'll give you an example. In 2022, we saw the bond market lose 13%, in some cases more. Never happened before. We saw the bond market lose money in back-to-back years. Never happened before. There's a lot of things that go into that story, but my point is that people lost faith in the power of investing in things that are conservative. So that's one thing post-pandemic that I think caught a lot of people by surprise. And that the reason why the bond market lost so much money was inflation spiked, interest rates went higher, and it caused this loss. But yet bonds over the last 100 years have paid anywhere from 5 to 6% annually with almost no risk.
Yeah.
So what we saw was the other side of that is that, well, I don't want to own bonds. I'm just going to go out and buy the best 7 stocks, otherwise known as Magnificent 7, because they're the only things that matter. The one thing about the American economy, it's incredibly diversified.
Mhm.
The number one product we make in the United States, physical product, is agriculture. Number 2, education. I bet most people would never know that. We have the tech sector, which is far and away superior to the rest of the world. But at the same token, there's a lot of other good companies. If you took those 7 tech companies, you could roll up 450 S&P companies, and it won't be bigger than those 7. So there's a lot of unusual things that have happened. And what I think some folks have also falsely fallen in love with is that the AI boom and those 7 companies will permanently go higher. And it looks a little bit like 2000, and we can talk about this later. It's not
Yeah.
the same. It's definitely not the same. But there is some worry about those are the only things that matter and nothing else. Being diversified, owning bonds, having some safety in your portfolio matter. And that's concerning.
Again, behavior, right?
Behavior.
It's the excitement. Jordan always says that's the
Yeah.
dopamine hit you get from
Yep.
those things going up in an exciting manner, right?
Exactly. The home runs have been too prolific.
Yeah.
And that's great, but you win the baseball game based on singles and doubles.
That's right.
You don't win with just home runs every inning.
And when you only swing for the fence, you strike out.
Well, I tell the clients all the time, it's not that we don't want to make as much money as possible.
Right.
Everyone wants to have their cake and eat it too. But what I do is planning. And in order to mathematically plan, you have to have more consistency around the numbers.
Let's use math.
And so how do you get more consistency?
Consistent returns, singles and doubles. Let's just reason why we don't want to own 7 stocks that have made a bunch of money. Let me give an example. Let's say you walk into a supermarket today and you really want to buy a box that's your favorite cereal. And that cereal happens to be the most popular cereal in the marketplace. When you walk in, it's going to be on the top shelf, the most expensive, and probably half the boxes are gone. But then you look down below on that bottom shelf and there's a new brand that you never heard of before for half the price. And you ask yourself, well, maybe it's time that I pivot. Maybe I should buy, no, I really want that cereal. So what's happening right now is everyone's buying just those really expensive 7 boxes of cereal. But yet all those other stocks out there are a lot cheaper. And you get much better long-term return if you buy things that have more value. You're buying the most expensive companies based on what their current price is and how much they earn. So that's a problem because we've seen that throughout history. Every time companies got really expensive, guess what? Eventually they sold off. For example, 10 years ago, if you look at the top 10 stocks of 10 years ago, only 2 are in the top 10 today.
Yeah, wasn't like Exxon one of them?
Exactly. GE. Everything pivots. So I think sometimes you got to take that with a grain of salt and be concerned. Let me add one other point because I feel like I left it behind. If I've got $1 and $1 goes down by 50%, I have 50 cents, right? Cut $1, that's 50 cents. But if that 50 cents go back to $1, I got to go up by
100.
100%. I've got to double it. So where I was going with this is those really expensive stocks is all you own and they sell off. It's really hard to make that money back. So to your point, if you plan and you're diversified, you reduce that risk quite a bit.
Yeah.
It doesn't matter how much you make. It matters more how much you lose. The less you lose, the more you make long term. That's just math.
Yeah. And we always talk about how much you keep, right?
Yes.
Net of taxes.
Yes.
So in your view, from the beginning of the year to now, do you feel your view of the economy's changed, or how has it changed?
This will be a fun one. I'll try to make this quick. I want you to, in your mind, split it into 2 paths we can go down. Path 1 is going to have this sort of beautifully paved gold road, perfectly manicured, lower bank regulations, lower taxes, especially corporate taxes on manufacturing, a pro-business administration, and potentially the ability to have less government spending, more private sector spending, which government spends less, private sector grows, lower interest rates because inflation comes down. We get a U.S. economy that grows north of 3% per year for the next 3 years, which fixes our debt problem. It is Shangri-La. The other road. Lots of rocks, potholes, broken down trees, because this experiment we're in of lower taxes balloons the deficit. Because of tariffs, inflation stays stubborn and maybe goes higher. Unemployment weakens, and banks still struggle to loan money to start new companies. One of those 2 paths happens here. I bet if we ask most of the folks on this, the older folks are going to say, I think we're going to be okay. The younger folks are going to say, nope, things are terrible. And we're watching that every single minute of the day to see which path is going to happen. So far, the success path is showing more signs than that thorny, bumpy road path.
When I counsel people in pastoral work, one of the things that I've come to understand, say I have a husband and a wife, and they're having some marital turmoil. He sees things like this. She sees things like this. And what I've come to understand is that the truth is somewhere in between that. So I wonder, do you see the potential that there's a path somewhere in between there that's more likely?
Well, let's go to the facts where we are right now.
Okay.
4.2% unemployment, some of the lowest of our lifetime. Folks forget that. Anybody who wants a job can still pretty much find a job. For every person looking, there's actually more than one job open. Wages, which is a really important thing for me, over the last 8 out of 10 years are above the rate of inflation. Why that's so important? The person who makes less than $100,000 a year has got a real wage boost. Do you know the average income in the United States is quickly approaching $70,000?
Oh, wow.
We're at levels we've not seen ever before. Why? Because of those huge bumps we got post-pandemic. Just for an example, you know a guy riding that bike in New York City that wants to run us over every single day delivering packages? They make $22 an hour.
Good night.
I kid you not. Now down here, you all have a little bit different rules, but I guarantee the person who works at McDonald's here is double where they were pre-pandemic. So that means we're lifting up those 100 million people that are below $100,000 in income. Why that's so important? They're buyers. They're getting married. They're having babies. They're consumers. So to answer your question, with low unemployment, low wages, and I do really like one thing in the bill that passed was the ability for anybody who wants to start a company to completely deduct the cost of starting that company right now. Huge.
Yeah.
Because that takes corporate taxes down. So what's happening, to your point, why it's a bit more shiny than dark, we've seen $500 billion already be invested since actually late 2023, accelerate in 24, and really accelerate in 25 in new manufacturing facilities. Just recently, the discussions around lithium, multiple heavy metals, uranium, and so on suggest that there could be a bit of an American renaissance in manufacturing. We'll never go back to a manufacturing nation, but a lift off there, very powerful to us. Add to that banks lending easily. Sometimes we forget the core of American capitalism is your local bank that lends small businesses money. And the big thing, if AI is as powerful as I think it is, and it makes us even 10% more efficient, that means we'll see inflation come down.
Mm-hmm.
So if you get a low inflation environment, which hasn't happened yet, we've gone from 9 to 3, we're stuck at 3. If we can get that down to 2.5, we see interest rates fall to, on a mortgage of about 7, they're now down to about 6. If we can get them down to 5, well, then suddenly we're going to be rip-roaring hot. And I think that's an exciting time. So I don't know that it's going to be one path or the other,
Okay.
but so far it's to the left. I don't know it's even down the middle because we're already down the middle. Right now, there's a lot of bad headlines on the U.S. economy, but it's actually pretty good. And by the way, one thing about this, politics are irrelevant. Don't let politics affect your investing. Economies are cyclical. Some bills change between the president, House, and Senate. At the end of the day, it's a cyclical thing that takes years to develop. So don't let you get too worked up about politicians and economics. They don't necessarily go hand in hand.
Where do you think over the next 3 to 5 years the biggest growth opportunities are?
That's a good question. So let's assume you win one of those folks who did really well in the Mag 7. Please take profit. Take back some of the money you originally invested. And you want to go to areas where in a growing global economy and a growing U.S. economy, other areas that haven't had this wonderful growth. For example, small cap stocks. Back to my cereal box analogy, they're the ones not only on the bottom, they're in the discount sale rack in the back of the store. So the reason why we call them interest rate sensitive companies, jargon meaning when interest rates are high, it stinks. When they go to borrow money, they got to pay 7% just like you do, if not more. Well, what if interest rates fall? Now they can borrow money less expensively, making it easier to start a business. And if you see the economy starting to expand a little bit, well, then you're getting growth from all of us spending more money. You're getting growth from adding a new company. Oh, yeah, wait, sweetener. I can deduct all the money I spent on starting the company or adding a new division. So I think small cap stocks.
So real quick, to your credit, we were at a conference Ladenburg had held and had a lot of the money managers from different funds that you guys use. The real cool thing is I like how you guys incorporate some of our input. And we had a big, I don't want to call it a debate, but conversation amongst the 100 advisors or so that are there and the money managers about small cap stocks. This was like a year ago.
Yeah.
And we were sitting there talking about when's the right time to get in that, because you know what happens if you wait until interest rates start to drop.
Yeah.
Right.
Message right. Yeah.
To Phil and his team's credit, they got involved with small cap stocks earlier this year, but even before the interest rates started to come down, and it made portfolios on that piece, on that sliver, suck wind a little bit.
That did in the beginning.
But what's happened recently?
Ripping the cover off the ball.
Yeah.
Number one asset class of the last 5 months.
Yep.
And so as rates go down, your credit card's cheaper, your auto loan's cheaper, your mortgage is cheaper. And if you run a little business, you can borrow money cheaper. That's a big deal. In fact, in a couple of weeks here, it looks like the Fed's going to cut rates again. The benefactor is all of us and smaller companies.
Having the sensitivities and the expertise to anticipate that in advance, I think it's a very powerful testimony to the benefit of having good money managers in your corner. Good, because if you're a keyboard warrior and you want to do it all yourself, do you have the expertise? I'm sure you could tell us quite a bit about the team of people you have working with you that are following all of these things intimately.
Yeah, every day.
Can any single person really do that?
Well, I'll give you an example I think some of the folks who listen to your podcast maybe can relate to. Think about a farm. 100 years ago, you needed 1,000 people probably to manage a 10,000 acre farm. Because of technology, the number of people on the farm is greatly reduced. Our business is the same way. We used to need many more people to trade. Today, we manage in excess of $7 billion. We have over 40,000 accounts. We serve people all over the country. So I would normally take a whole army of people to move that. Today, we can do that significantly more efficiently. But to that same farm analogy, I still need to have people on the farm who know what season are we in?
That's right.
What's the best crop for this time of year? Is it too wet so we can't plant corn versus soy? You all know stuff better than me, but
rice.
So in a way, rice.
Right.
Sorry. So knowing how to manage the crop still requires really intellectual people
Right,
using
right.
technology to make it
Right.
faster and
You
more
can have
efficient.
less people,
Right.
but they can't be less competent. In fact, they've got to be more competent.
Mm.
They've got to have the competency in the right tools
Exactly.
and in the right area. One of the things that you study in history is that as civilizations grow, one of the true marks of civilization is specialization.
Yeah.
People specialize. It's not that everybody's out there working on the farm. It's that you have specialized people working on the farm that make it exponentially more productive than if you had a number of incompetent people working there. But those people can take their talents and they can go apply it in a specialized place and they can make it grow. So it goes back to what we said there at the very beginning. Everybody needs experts.
Mhm.
Yeah.
You can fix your plumbing, but you don't do that every day.
But that goes back to your comment. The average person by themselves, unless they're going to do this all day long, I spend 2 to 3 hours a night reading all the information I can. If that's to read, stay aware, be a specialist, know the technology, and be able to apply it. If you look at our ability to do this versus 20-year track records going back at one of the best in the industry, and I'm most proud of, heck, anybody could have a great year last year.
Right.
Market
Yeah.
moved higher. Look at how we did in 2008 when we had to know that the market was going to fall apart. 2020, 2018, a very difficult year. And the body of work tells us that by being prudent, by being good investors, being specialists, and using a team approach, it's worked at losing less when markets
That's
are
right.
down.
That's right. And one of the concerns that we deal with when we have prospective clients
Mm-hmm.
is, well, what's the cost?
Mm-hmm.
Well, there's two questions I think that are in that, but one of them really doesn't get asked. The first one is, what is the cost of your expertise? That's the question. But there's a question underneath that really needs to be paid attention, which is, what is the cost of a lack of expertise?
Mm-hmm. The opportunity cost.
The opportunity cost. Exactly, yeah.
The client that we visited with today,
Yeah.
I mean, down 6%
It's tough.
relatively from where he could have been. And it's not 6% on the dollar, it's 6% on $500,000
Oh, my gosh.
in
Look
one
at that in
year.
dollar terms.
Yeah.
The cost of a
$30,000.
lack of
Mhm.
expertise.
Yeah.
Yeah, so when you look at today's economy, I will say it's a bad knock for what folks look at it. So going back to that person, whoever was handling their investments, probably had some political bias, probably thought that the economy was falling apart,
Mm-hmm.
probably thought that the more prudent way was a hide on a mattress when the reality is facts.
Yeah. He made a presidential comment
That's
a couple
exactly
of
right.
times.
That's exactly what it was. It's very politically motivated.
And the facts
Yeah.
don't say that.
You're
You
right.
got to stick to the facts.
But when you get emotional,
Blow
you
it up.
can't hear facts.
My job is to keep it to the
That's right.
facts and make investments based on that.
So let's put a crystal ball on for a second. Why do you still truly believe U.S. economy is probably the best in the world?
Well, first off, just our current growth rate is more so than any other developed nation on the planet other than China. There's a lot of issues with China about who they are, what they're ultimately going to become. Terrible demographics, by the way. There's 1.3 billion Chinese today. There'll be 660 million by the end of this decade. They don't have any babies. Why? Because they treat their people so badly. But the reason why the U.S. economy is so powerful, first off, immigration. If you took the rest of the world's immigrants, roll them up, we're double the rest of the world. I'm a very pro-immigration person. Why? Because it matters to people want to have families, babies, success, and population growth.
Yeah.
And by the way, they tend to be very powerful people and work really hard. Second one, believe it or not, patent rights. We're really the only country in the world that has traditional patent rights. No one else has that. If you have an idea in France, it's not your idea after a very short amount of time. But the third one is bankruptcy law. Most countries in the world won't let you go bankrupt. They're going to have a lien over your head forever. In the United States, you make an investment, didn't work out, you walk away. Fourth one, commodities. We have all the commodities that you can need to start a business. Those are founding principles. But I think what makes us such a powerful model is its ability to reinvent itself. For example, 82% of the country's workforce today works for companies of less than 250 people. So what's that mean? Small business is the engine, the horsepower of capitalism. So why do I think capitalism is so successful? More new businesses were started in 2024 than any time in history.
Wow.
Now, on the other side, more were closed than any time, but that's okay.
Yeah.
That's that constant rebirth of capitalism.
Mhm.
And why that matters is some of those are brilliant ideas. I bet in this area, there's some restaurant that took off that people go, that's an example of it. And you look at how our country's made up today, and there's some wealth issues. The top 1% own basically 30% of American assets. The bottom 50% only own 3%. It's not that different over American history. Post World War II, there were some issues like this, post Depression. My point is, there is still the ability to create real wealth in the United States via investing and how you find an opportunity. That wealth gap will get fixed. Why? Because as the boomers pass on, when 190 trillion go from that generation to every generation, their success will be translated into everyone else's success. So I'm not worried about the gap. I do think what makes American capitalism works is its diversity, those 4 tenets I talked about, and the power of small business to be able to create this real growth of the country.
So I've been talking a lot with clients about the labor shortage, right? Part of the reason why several years ago I didn't think inflation was going to come down real fast was because of labor shortage. Because if you have a labor shortage, then that's going to force wages up because there's competition for people. And if people make more, what do?
Spend more.
And so you talk about China and their issues, but one of the problems we have is we don't have enough people coming in at the moment, right? We've got a broken immigration system. Say what you want about legal, illegal, whatever, but the system's broke, needs to be fixed. Then we don't have the birth rates that we used to have before. And even if that were to spur overnight, it's not like those people are going to become 18 overnight. So how do you see AI impacting that?
So we add on to your point, demographics matter. If you look at Europe, they're shrinking in population. When your oldest generation is your biggest and your smallest generation is your youngest, you don't generate enough revenue taxes to pay for the oldest generation. Japan, another great example of that, rapidly approaching the age of
Greece several years ago. Yeah.
On and on. That's why Europe hasn't grown in decades. There's not a single company in Europe that's worth $1 trillion. We've got multiple $1 trillion firms. Going further, it's not a single company in Europe worth $500 billion because they don't grow. They're watching their exchanges shrink. So when you get back to demographics, they really matter. So let's bring in AI. Today, of all American companies, less than 20% are using it for their workforce. In 3 years, only 20% won't. So in other words, we're going to go from only 20 today, in 3 years to 80%. Or put a different way, the average revenue of a Chinese worker is about $15,000 per year. The average revenue of an American worker goes to $145,000 a year. So if you think about that, every hour work saved will either translate into a better quality of life for the worker or higher revenue or a bit of both. So ultimately, I do think AI has a profound impact on our ability to be more efficient. And what do we do with that time saved? Do we work harder and make more revenue, or do we enjoy it? I bet it's a bit of both. I think we'll be that much more powerful for the United States.
To narrow down to how AI will impact specific industries, how do you think that the advent of AI and the acceptance of it is going to affect the advisor-client relationship in the financial industry?
We have these things in the way called regulations. And regulations are going to make that slower and thornier because none of the regulations around the SEC or FINRA are going to let us have the bots communicate with the client without us supervising or being directly involved. That's going to take a long time. But what I do think it means when we have conversations, we'll have much better quality of what the conversation was about, our ability to follow up, and our ability to communicate. For example, just for fun for all of you who haven't used it yet, go on to Google, and Google now is backed by Gemini. You don't even realize it's happening. And just go in and say, hey, Gemini, please make me a song. I like the song to be about Texas. I want it to be a female voice. I want it to have sunshine, but I don't know, the bayou, and I don't know, whatever else you want in that song. And
Gumbo,
that's what I was thinking. Gumbo, crawfish. So I saw a crawfish sign on my way here today. And it'll take it about maybe a minute. And it'll create the song, and you hit play, and you hear it live. So our impact of being more efficient, the song won't be perfect, but it'll show you the power of what this can create. And I guess the point is, when we're writing communications to you all, they'll probably be easier to read. When we're making sure we're not missing something, it'll help us track it. And then most importantly, I think it'll make us more efficient, which hopefully allows us more time to where we started this conversation, educate on not panicking, on what we're doing for you, and maybe help you understand a bit more about finance where we haven't done a very good job in doing that.
Yeah.
I think one of the things to remember too is that AI is artificial intelligence. AI is only as smart and accurate as the information that it is fed.
Mm-hmm.
We've done quite a bit of research on different topics in different areas where we come together and we meet about it and we say, well, that's not true.
Right.
Talking
It
about-
was the IRA contribution limit for this year.
Yeah, somebody asked about it, so I typed it in. I said, what is it? And then I fed that to Eddie, and he said, that's not right.
That's all right.
He went to the hard copy from the IRS and said, it's this.
Yep.
Sure enough, that artificial intelligence was,
Hallucinating.
that's
Yeah.
right.
That's what we call that.
Yeah.
In fact, McKinsey's being sued by Australia for using an AI bot to help them make their pension system more efficient, and it hallucinated.
Mm.
But that's a good point. And so much fear about AI. I don't fear it. It's a tool. It's no
right.
different than the hammer. It's a tool for information that you use to make a better decision, but you'll make sure it's right.
Well, and there's always good and bad with technology. Some guy in the 1800s riding his horse, and all of a sudden there's this four-wheeled thing driving down the street,
Yeah.
and he's thinking, "Oh, I'm never going to use that. That's going to kill somebody." Have automobiles killed people?
Yeah.
They have, but net benefit to society was what?
Enormous. Well, I think that's a critical point because, for example, we'll talk about investing in that crystal ball. AI is a great learning tool. Maybe it helps people in rural areas learn better. And we raise our educational standards, make learning more accessible. But the power of AI isn't just investing in NVIDIA and what it might do from an investing standpoint. The entire American electrical grid is going to be torn down and rebuilt to be more efficient, to be able to move power in any direction, use nuclear and wind and water and solar, but then go further. How do we make it more efficient with hydrogen? All this is a byproduct of AI. Why? Because the data centers have to be built. If we take the rest of the world's data centers, roll them up, the United States has more than the rest of the world combined times 2.
Mm.
We're all in on this. But people have to run the data centers. To your point, is the data going in right? So it's got to be governed. We want to make sure the outputs are sound. God forbid some crazy hacker got into an AI bot's data, manipulated it, so the outcomes created real panic in society. So you got to be careful of this. What does this mean? There's a whole new industry of jobs that are going to be
That's right.
spawned
That's right.
in the regulation and governments of AI. So it's a useful tool, and I think it's going to be powerful in not only the rebuild we need for it, but also the governance of it.
Well, Phil, thank you so much. This has been great. I love talking to you. I love your insights. If you enjoyed today's conversation, please remember to like, subscribe, and share.
That way you won't miss out on future episodes where we get to share with you some financial insights from all about the industry.